Hey, Alpha fam, welcome back to another episode of Alpha Commission. Today on Alpha Commission, of course, we're going to go over the dangerous precipice upon which stocks and crypto are hanging and looking over the edge as the world faces essentially economic disaster and potentially even World War III. Guys, we are just monitoring this situation. Of course, there are no easy answers here. You do see crypto taking quite a hit. Stocks do seem to be down relatively across half of the board, with some of these safe havens kind of pumping off of the intermediary support that we have going on here. Guys, we do see this red just spreading across the world as the dollar does pump, and of course, that just is contagious everywhere. And if we go over to the Market Watch news this fine Tuesday here, we do see that the New York Fed 5-year inflation expectations did actually pump to a 2.2%. So, not that 2% target, which Federal Reserve Chairman Jerome Powell is targeting with his interest rate hikes, but rather 2.2%. And that's pretty dangerous, guys, because that suggests that the New York Fed doesn't really believe that the chairman can get to his goals. And so we are seeing where the compromise may end up coming in, but also we're seeing that the Federal Reserve may just fail. And if the Federal Reserve is failing, then of course that does suggest that they could try even more aggressively, because all of these are just projections, they're not actual failure yet. So the Fed could try more aggressively, and we could be entrenched in this mess for longer than expected, perhaps another 6 months to maybe 9 months. And I think that would be a reasonable expectation given the current orientation of the world and just how dug in the Ukraine and Russia situation is, just how kind of idiotic China has been with their zero COVID policies, which has just been massively disrupting manufacturing and the economy in China. And then with banks as fragile as they are, from everywhere from China to the UK. And with the Fed increasing interest rates, of course, that does put huge pressure on these small countries, which trade in dollars because, of course, their own national currency isn't very valuable on the international stage, the US dollar being the world reserve currency, and everything being traded against the dollar. As the dollar rises, as the Fed increases interest rates, as the world demands dollars because they don't trust their own currency, they don't trust their own governments to handle these problems better than the U.S. Consider, we are in a special ed, classroom, and all of these Federal Reserves are doing things a little bit slower than what they should be doing, at least by some type of arbitrary standard. And right now, as much as we love to criticize him, Jerome Powell looks like the sharpest tack in the tool shed, and that's quite scary, to be honest. It does reflect just how fragile the world system is right now. Of course, there are smaller countries which are doing it better, but they just don't have the global impact that the US does. And then some of these medium sized countries like the UK, I mean, they're just pouring gasoline on the fire. And so it's quite a dangerous time to be in high risk assets. And that's why you do see things like stocks and crypto heading down, and they will continue to be suppressed until it looks like either a global recession forces the Fed to pivot, or until the Fed has slowly and gradually over time, perhaps that 6 to 9 months I was talking about, managed to hammer inflation down by getting rates incredibly high, higher than what people might expect, unless, of course, there is that global financial crisis which intervenes and then takes care of inflation by the mere fact of it being a financial crisis and therefore killing demand, therefore killing inflation, which then would require the Fed to come out and perhaps even ease as we have a global liquidity crisis, as we start to see deflation actually starting to kick in. So, guys, a lot of troubling things on the horizon. We have now moved from hyperinflation to stagflation, where we are. We are starting to poke our toe into the real recession pool. We're in a technical recession, more or less, but we are now entering the stages of perhaps a real recession as we see jobs finally starting to taper off, although the last jobs report did suggest lower unemployment than previously, which does suggest Americans are even more employed now. So it is mixed data, but of course, GDP and jobs have to go together for a real recession. And so, as we see the projections for the next quarter looking pretty bad, we can expect layoffs. We can expect a cooling down across the globe. And so we most likely will be entering into a real recession no matter what, probably in quarter four and definitely by quarter one of 2023. And then whether or not the recession becomes a global financial crisis is still up in the air. It looks highly probable, especially if the Russia Ukraine conflict continues, especially if the dollar continues to shoot up and these other countries can't get their currencies under control. And guys, we will be watching out for 2023. It looks to be a little bit treacherous, and hopefully, the bottom of this market can be confirmed by spring 2023, and if not, the latest summer 2023. I hope, with maybe expectations of some rises, perhaps by the end of the year. Of course, I'm talking about all the asset classes combined. Some asset classes like crypto may respond with various different types of relief rallies or fools rallies or fits and starts that just fizzle out. But we'll see, guys. We'll see. Moving forward. We do see that we have the CPI data coming out on Thursday, and of course, depending on how good or bad the CPI data, which is a measure of inflation, that does determine whether or not the stock market will just take a sharp angle up or down. Of course, if the CPI data is neutral, maybe we just hold flat, or because the market already is calculating 75 basis points into the next Federal Reserve, rate hike. And so if the Federal Reserve just increases 75 basis points, which is already considered a jumbo size increase, then most likely the market has already absorbed that largely. 80%. There will be a little bit of a shock because of this 20% that's expecting 50 basis points. However, if the Fed only increases 50 basis points, let's say the CPI data is really good, then maybe the Fed only increases 50 basis points, and then stocks will likely to pump, as will most likely crypto going into that. Guys, let's go ahead and jump to the charts. But briefly, I just want to introduce myself to any of the new watchers that may be out there. Of course, I did call the exact macro Pico top 1 month in advance. And so when you're listening to me talk about macro, I do have a global politics and economics background here and have worked in international trade for over 10 years. So I do know a little bit about what I'm talking about for different types of cycles that the world may see. And I dare you to find anybody who called a 70K top on Bitcoin using a model that they generated themselves, right? And actually applying logic, not just calling out a number 1 month in advance here in October before the Pico top, and actually calling the exact number 70K if it's a rounded top, which it was, and then a possible crash, a cyclical sine wave crash. And what do we see here? A cyclical sine wave crash on Bitcoin with our rounded top at 70K. So I nailed it, and that's who you're listening to on this channel. Guys, I additionally, once that top was confirmed around where my friend Crypto Retta and I were discussing EMAs at around 62K and how they were starting to cross, I did additionally kick in to start to warn people and call for them to just get out of this market around 59K, which was my threshold for the proof that I needed for this to be a confirmed turnaround. And then, of course, I was just telling people to sell every chance they get, sell every chance that you get, all the way down. And of course, I've just been trying to be a friendly protector since then and improve my trading, because I know that if I don't know how to trade, with the style that so-called experts trade with, that people will ignore what I'm saying. And so I have been trying to steadily improve myself for credibility, but I do want you to understand who that you're dealing with. And then, of course, in January and December, I did call for a 15 to 25K Bitcoin, emphasizing the importance of 25K, but then highly suggesting that we could, in fact, go much deeper. And that was when we were still 50K, and people believed that we were still going to turn around and go to the moon. No one believed that 15 to 25K was possible, but I was, in fact, looking after you guys. I was calling for that. I did have the model to suggest that that would happen. And even a year ago, I did introduce you to the stocks and commodities super cycle, which of course I've mentioned many times. This is just one instance. And so using these alpha origin channels, which I developed, of course, some other guys had origin lines, but I pioneered the origin channels for the purpose of these stocks and commodities super cycles. And I can prove that earlier than anyone that I've been able to find in crypto. And so, guys, this is who you're dealing with. So now let's go ahead and take a look at Bitcoin. And for Bitcoin, I want to show you the alpha origin channels that I have developed for us. Of course, we haven't gone over this in a while, so it is good to just check in once in a while, and just so that we can see where we are. Of course, on the linear chart, it just looks crazy. But if we go to log, which takes into account parabolics, then you can see that these are in fact curved lines. These are not straight lines. These are curved lines, because we are on the parabolic chart, right? And so as these lines curve up, that's why when I go to the linear chart, which is just normal, they look crazy. If Bitcoin had had a blow off top, not a rounded top like what we experienced, and my condition for a rounded top was to stay within these purple lines, and we absolutely did that when we hit that 70K that I called, right? Had we had a blow off top, then yes, we could have easily hit into the middle of this pink range I have here. This is the blow off top range, which would start, somewhere around that 100K, and could have gone as high as 225K if it had the same ratio as the blow off top in 2017. And that's where you got all these moon boys calling for this. Of course, what they didn't understand is that we were having a macro stocks and commodities super cycle, which was the concept that I was introducing back here when no one was even thinking about such a things. Of course, that is now commonly called the quote unquote everything bubble. That's what people are calling it now, and that was of course driven by that free money by the Federal Reserve printed during the Trump administration, primarily that $9 trillion, where Jerome Powell just injected cocaine straight into the vein of not only the U.S. but the entire world, using U.S. dollars for liquidity as they tightened their own economies during the global crisis there, where they shut down their own economies. And so what did they use? They used the free loans, they used the liquidity from the United States in order to fuel all that. And now the chickens have come home to roost. That was all fake. It was all a bubble. That was a fake economy. It doesn't matter how good you thought the economy was back then during the good old Trump administration. That was fake economy, guys. Like fake news. It was a fake economy driven purely by your money in the form of the inflation that you are now paying, and that's just a fact, okay? So that's why we ended up with a double top. It could not be sustained. There was no real economy to support it, and we would have crushed the republic had we kept going. And so of course a tightening policy had to be put into place. Otherwise it would have just been infinite money spending. And being having that back into place, we are seeing things return to a normal level, which of course we have now begun to dip into and under. Anywhere between this yellow line and this red line, I consider a fairly regular zone. There is a parallel for stocks, but of course, if you exceed these lines to the upside, then unfortunately, it's just the nature of markets that you're going to exceed them on the underside as well. And so there is that cyclical sine wave that does take effect in most processes that are kind of mathematical, or that have these type of patterns to them. And so the stock market, and of course now crypto, are one of those. It is not just up only, but it is of course up and down. And so you do have those crazy bull runs, but you also have the crypto winters. And so now we're seeing that crypto winter cycle be put in. And of course, that could go on for quite some time, just like the top of the market can. And so you're also going to see quite some time at the bottom. Probably, again, it could be not only this year as a decline, but then you can see sideways for also like a year or two. It is possible. And perhaps in 2025, we are going to see that just massive incline in the market. But unfortunately, due to this double top and the technological cycle that we're in, most likely the next height will only be this kind of midsection, sort of like what you see here. You see this mid-cycle high, right? And so probably we can get something like that. Let's just pretend this is the bottom. You get a mid-cycle high somewhere like that. And then, later on, 2024 into 2025, you get whatever action you can get in these purple zones up here that are just overheated, right? And so this kind of mid-cycle peak would probably be somewhere, between, let's say, uh, just 40 to a 70K is just what I would suggest, okay? Just for a reasonable expectation, 40 to 70K. And then, of course, it could be as low as, our good old CME gaps, which if we take a look to see where the CME gaps are, yeah, I mean, it could be as low as 35K, right? If we just wanted to put a low there, um, maybe even 30K, which could be quite underwhelming, especially if we continue to go low, then our mid-cycle could end up here at that kind of 30K, maybe kind of spiking up to that 35, filling in some CME gaps before coming back down. And guys, the bottom of this green range that I have here, let me clean this up a bit, is that 12K, it's that 10K that people have been talking about. So we are touching the grass officially. That is why I'm showing you the alpha origin channels once again. Of course, I did make up these alpha origin channels on my own. I did see some other channels starting to copy it. Of course, they're using origin lines, and their origin lines are totally wrong. They've completely misaligned their origin lines. I arranged it correctly, and then I developed the alpha origin channels around it. And so we have just had a huge predictive ability over some of the competition out there where we could see this capitulation, we could see this capitulation, we could see this capitulation, and then we also know we are underneath the bloodline, which could end up taking us to the bottom of this green zone, which I call touching the grass, right? Because of how it works with this sine wave cycle. And of course, sitting on the bloodline or below it is usually a good DCA point. Very few people have this concept. They don't even understand what I'm talking about here. But of course, because I've developed these alpha origin channels in combination with the macro stocks and commodities super cycle, you can see, of course, where we are in this process, and you can start to target where you think a bottom may be. Now, because this is a stocks and commodities super cycle, I do suggest that this full range is within our purview, and that's why I say anytime we're below the bloodline, I couldn't, you know, tell someone that they shouldn't DCA in. The only thing that I know is that you should not DCA in when we're above my bloodline. And of course, if we're starting, up here or up here, then you have to wait until we cross the yellow line to buy again. And the white line, is likely to be the next point of capitulation, as is the yellow line. And so, guys, it's better to just buy under the bloodline, in my opinion. Of course, as you can see, just like we can have these mid cycles to the downside, we could have a mid cycle to the upside, and then we have the full cycle to the bottom, the full cycle to the upside. And so, guys, could we have a reversion like this and then come back down? Yes, that is possible. So just be aware that this doesn't have to progress linearly. These things can bounce around, right? It doesn't have to like just go in a straight line to any one direction. Most likely we'll explore these levels, but as time goes by, those levels actually rise in price, and so they could be quite high prices down the line if we do manage to avoid it in this cycle. So again, that's why I say like if we're underneath the bloodline, like I can't really stop anyone. I can't really give any advice not to buy, right? Plus, I'm not giving financial advice here, but it is a relatively good value. Now you guys say, well, are these lines for real? Well, look at how the price action lines up with my lines, right? Look at how the capitulation lines up with my lines. These were all marked out in advance. I did not mark them out after the capitulation. I marked them out before the capitulation, and they filled up my lines perfectly. And even look at the bottom of our price action since June. Since June, we have basically been hanging on to my bloodline. We just had that flip onto the bottom side of the bloodline, and what's scary is that we're kind of pushing off of the bloodline, having retested it. And so that does suggest to me a further downside. Now, as long as we were above the bloodline, as long as we were above this kind of 20,250, and of course that price rises over time, 20,250 is the same number as 17,500 just a few months ago. It's all on the bloodline, guys. And so these prices rise dramatically. But having broken down from that, it does suggest there could be further downside. And if there is further downside, then unless it's going to be a flash crash like we had in the COVID days, right? Which I find very unlikely, then most likely it's going to be a chop, right? Something like this. And then that chop could take quite some time. And that could be why it takes until 2024, 2025 to really start seeing those next numbers. And then you could see that if we do get into these green areas down here, this amount of rise right here is very similar to this amount of rise right here from a parabolic standpoint, right? Because we are on the log scale, and so this is parabolic price action, and so that's why these prices somewhere between let's just say 30 to $70,000. That's why it's such a reasonable target, because look at this target from here, right? That would be this target right here. And so that's quite reasonable price action from a Bitcoin perspective. And yes, I do see, as long as we're breaking below my bloodline, that $10,000 is within reach. We could break down and we could actually hit $8,000 as we just kind of flash wick and then pull ourselves back up to my touching the grass line, and then we can work our way back up to the bloodline and get into our mid cycle, and then who knows what we could do from there. It just take time for the market to heal and to finally put in some type of accumulation wedge. That type of accumulation would then suggest a pop-up, and of course we could see that 100k plus Bitcoin perhaps in the next cycle, or at least after we have a mid-cycle high. Okay, so I don't want to project the next high. I can only project the mid-cycle, which is probably very conservatively 30,000, and then probably somewhere around 50 to 70,000. And, if you wanted to be just a moon boy, then maybe like 90,000 or whatever, some spike above our previous levels. But most likely we're going to have a triple top, right? A triple top, which is going to put in an accumulation wedge. And then maybe we have a fake out to the downside before pushing up into this accumulation wedge, which would occur over, of course, a couple years, right? And so, guys, this is the model that I'm thinking about, that I'm constructing. And accumulation wedges are no joke on the macro like that. You can see we've done this time and time again. It is a time-honored way of just popping up into the new cycle. And look, a fake out, right? So, of course, if we have another accumulation wedge, well, wouldn't it make sense that we have a fake out to the downside before we push up? I mean, think about it, guys, right? Like, that's how the market behaves, to just have quarterly backfills and to shake out the market. And so, what do I see as most likely? Yes, I see most likely we continue to the downside here. But again, like the bloodline is really is a very important line on my chart. It was the top of this era, and it is the bottom of this era. And so, can we make it the top to the next era? I think yes, that's highly probable. And if we do work our way down here, then maybe that's going to be our limit, somewhere around, again, that, like, 40k ish area, right? Ish, and then work our way back up, in the top of the next market, maybe top out around this area. Just delete that. Work our way down into the grassy area, and then we have a mid-cycle top on the around the bloodline, and then we work our way back up to that 70k area, and that's our market top. Maybe we get shot down, and then somehow we continue to go right as we get wedged into here with the next, so this is the mid-cycle top, right? And then we have the full cycle top, which is actually just going to be a triple top to our current top. And then we'll have a pullback that's not as harsh as this one, but it is going to be fairly harsh. And then we'll go into a next just massive, probably halvening or whatever cycle, right? That just takes us to the moon. But we're just not there yet. That's just many years away. So I hope that helps you understand the macro perspective. Guys, just quickly, let's go over the key levels to be watching, because of course that was our macro structure. But now let's take a look at our local structure, which of course we do have these various. Hmm. support and resistance lines, which for some reason are not popping up. Oh, there we go. Okay, we have our support and resistance up here, right? And so you can see that we're generally just acting within this bigger range. Yes, we could pop up here to 25 if we are able to find that energy, probably off of the CPI report, but just less ambitiously. Given the orientation of the stock market and the orientation of the world, we can see that we have a little bit more of this type of local structure right here, where we are basically trading beyond this range. Right now, we're just in the middle of the range, kind of underneath this kind of midline resistance. So or in between, maybe there's two midline resistances. And so I just don't really like taking a trade in between a channel like that. I'd rather take it at the bottom or at the top, especially earlier on when you can more likely reliably bounce around. The later you go, the more likely you're going to break out of your range, and so it just becomes even more dangerous. So personally, I'm not going to necessarily be trading this chop. This was the area to trade off of that higher low right there. And of course, when we got a rejection here, that was also a good trade to the downside. But for our current structure, we're just in the middle, guys, okay, of this range. We are at the bottom of this bigger range, though. So if you did want to consider to situate yourself in case the CPI data is good or in case it's bad, then you could be wise to be thinking about those bigger ways. We're not in the middle of the range. We are at the bottom of the range off of a higher low right there, which of course was the place to buy in on that bigger range. Let's go ahead and look at our superstructure that we have going on here. Of course, I do strongly advise us to take those head and shoulder structures very seriously. Sorry, I'm in log. Here's the linear chart. Of course, we had our double top, and then we had our head and shoulders, which I mentioned way back here when we were 50K. This is why I was warning everyone to get the heck out of the market, get the heck out of the market, get the heck out of the market, because we had a head and shoulders, a very technical one that would drive us all the way down to that 15K. And of course, I talked about 25K because people only believed we could go to 30K because of this bottom over here. And so I would always mention we can go down to 15K, but I mentioned I would use the headline number of 25K because it's more relatable, it's more believable by people who only believed that 30K was the bottom. Of course, now we're closer to 15K than we are to 30K. So, who's laughing now, right? Guys, we did put in another head and shoulders, which took us down to this bear flag. This bear flag then took us down to our current pattern. And look what we're doing right now, okay? If you guys just want to believe in price action, okay? Just price action, just go by price action. Look, guys, we have another head and shoulders being formed, and that could take us all the way down to 12K. So not only do we have the superstructure, which I pointed out, half a year or longer ago, 9 months ago, this is a superstructure that takes us down to 15K, but we also have another structure on one of these levels which can take us all the way down to a 12K. Obviously at some point these things will round out, but I just believe this stuff because it does tend to play out. When the charts are giving you these, for example, this distribution wedge back here in a 2018, 2017, this distribution wedge suggested uh, a measured move to the downside, and it was completely honest. All right, the price action took us there honestly. And then look where the price action took us after we put in an accumulation wedge. Boom, right? Like we actually had accumulation off of that. So guys, I believe the structures. I don't care if some people think that head and shoulders are hit or miss. I don't care how they interpret these things. I'm going to believe the charts. I'm going to believe price action. Okay, and so I've shown you my predictive ability. I've shown you price action. I've shown you the structure, right? And so now let's go ahead and take a look at some of these just the bearish patterns that we've been kind of putting in here that does suggest that our momentum is to the downside. Well, you can see we broke this uptrend, and so we're just kind of retesting the top here. I do suggest that we could possibly come back to the bottom of this range based upon the breakdown of this. Of course, that was related to this rising wedge, which broke prematurely. I did think we would have one more leg to go, but the market was just really bearish because of that 500,000 troops order in Europe, and then the dollar just suddenly pushed up like crazy. And so, yes, I do think that we are continuing to break down. So the bottom of the range is within reach. And so, personally, my bias is to the downside. I've mentioned that for a week now or so. But let's go ahead and just get rid of that one. I think I can remove that local structure. We already took a look at the alpha origin channels. Let's go ahead and take a look at our macro downtrend. You can see that we're just kind of hanging on to that macro downtrend, right? And so not really proving anything. We still easily could break below it again. But as I mentioned, this second boss is our real downtrend, okay? For the last half year, this has been our real boss. And so we are well underneath that one and respecting this kind of like zone at the top that has just shoved us down. And so if we are getting shoved down from that zone, history tells us that is a very powerful shove area. And so if we're going to push back up into it, most likely we're going to get shoved back down again. And then what would we expect? I mean, what would you expect, Alpha Fam, right? Of course, our good old head and shoulders are probably going to end up working its way out if we don't get above this 20,000, basically 300 zone. 20,500 is really the number that I was putting in for you. And so, guys, that's our price action. Okay, so what are the things that I go by when I'm trading? Price action, volatility, momentum, and then I also use EMAs, right? And so let's go ahead and take a look at our volatility. Currently, our volatility is still on the floor. We've had yet another flip in volatility, and so this thing is remaining on the floor, but you can see that once volatility goes, it can really go. And so we are just waiting for these volatility lines to sort themselves out while we have an orientation on our momentum. And of course, currently our momentum is to the downside. And so that would suggest that any volatility explosion, you can see just how intensely it's built up, any volatility explosion that could expand price action to the downside, okay, because of that bias. Now let's just check on the 4 hour. On the 4 hour, it does look like, come on, TradingView, load. Come on. Okay, on the 4 hour, we do have, our Stokes pointing to the upside while we're in a new contraction. I mentioned that we were expanding off of the 4 hour, but we are contracting to the upside, which does suggest that this is just some type of consolidation on the 4 hour. So I really wouldn't trust that as any type of a leader of a big move, and we're still waiting for that daily, guys. Okay, so there's volatility for you. Let's go ahead and check out our momentum. And for momentum, I'm just going to bring up our general momentum lines here. And you can see that we are well below the momentum area that I'd like to see us within. That's these blue lines over here. And so we're just totally underneath our momentum zone, suggesting we are losing momentum. On the 2-day, we are above that critical zone. So we actually bounced off of it quite strongly. So the 2-day is holding up. I gave us these signals yesterday, and so in order to be really bullish, like just to secure it, we had to overcome 19,500. Totally failed to do that. Look, we got hard rejected off of that actually. We had to get above 19,400 for us to be even bullish, and look, just totally hard rejected off of that. And so of course we were underneath the bearish line. And so, of course, the bias is in the bearish direction for yesterday. And then, of course, we didn't cross the oh no level. So, guys, we did hang on, even though we are bearishly biased right now. Turning off those signals, let's go to the momentum pools that I have for you. And so since we're analyzing momentum right now, you can see, of course, that we totally lost the momentum pool that I had assigned for yesterday. And having lost the momentum pool, it's like you're drowning, right? This is a pool, you can swim around in it, but you can't get underneath it. And ideally, you want to be above the tallest box that we have, or the utmost highest box that we have, and it's a 2 to 5 day projection. And we just failed to do that. We couldn't even get above the daily, and we definitely weren't above the 2 to 5 day projection. And so this does have a bearish projection for the future, but we'll see. Can we get back into these areas? Well, we have to update my momentum zones. And you can see that, of course, we're starting a new day. This is good for 24 hours. And the new momentum zone that I have here does suggest that we need to hold on to a 19,070, and that we do need to get above 19,335 to be bullish. And then to be hyper bullish, we still need that 19,500. Pardon me. So the 2 to 5 day projection, whereas this is a solid reality, this is just a projection of what I think for the next 2 to 5 days. The projection still says that we're not going to be bullish unless we're above 19,500. And but as far as surviving another day, if we're above 19,333, then that's going to give us our best chance. And then swimming around in this momentum zone, which we're currently on the border of, uh, you know, we're just going to live another day, right? But losing that line of 19,075 is going to be really bad. So let's go ahead and put our momentum lines back on. And we can see that, yes, that does correspond with our 2 day Stoke there. So I can turn this off. And let's see, where is our 4 EMA? Down here on the weekly. So that's no problem. Our 9 EMA is all the way up here. So that is a challenge. Now, our daily Stokes is actually extremely high, as is our weekly 9 EMA. So that's not good. I mean, we could actually come up and tag this 20,000, but this is just very far away right now, guys. So for a hyper bullishness, I don't even know what to call it. Um, I'll keep this level, and then I think bullishness has to come down a bit because our price action has fallen. Our bearish bias, of course, is going to be underneath our current boxes, and then our uh-oh level. I think we can pretty much keep it at the 2 day Stokes there. That does line up with quite a few wicks. So let's go ahead and turn off our momentum pools, turn off our momentum lines. And if you guys just want to have a general indication of what I'm seeing by momentum, then there you go. There's your signals. These are the key levels to watch for Bitcoin, assuming that you want a bias to the upside. You're going to want to be above this blue line. You're going to have a bias to the downside. You're going to be underneath this pink line. And then in between here is just kind of swimming around in that momentum zone, right? Those momentum pools that I have kind of marked out there. So guys, we've done price action, we've done momentum, we've done volatility. Next, we should check out our good old EMAs. And as we can see on the 4 hour, we do have the possibility of recovering the 4 EMA, which does give us a good chance at recovering the 9 EMA, and then perhaps entering a squeeze. So we are seeing a little bit of rounding on the EMAs right now, and that is a good thing. It's just that the 9 and the 21 are pointed to the downside. So unless the 9 starts pointing up, I'm not going to get too excited, and then the 21 has to point up really fast. Just like right here, the 9 pointed up, but the 21 never did, and so we failed, right? Whereas over here, the 9 pointed up, and then the 21 pointed up almost at the same time, and so we did have a massive squeeze to the upside. we'd be looking for something like that on our EMAs. On the daily, that was the 4 hour. On the daily, I can expect this to be quite bearish. Yeah, just everything is pointed down, so none of this looks good. You do see some softening, so that's a good sign. You do see some pressure on this wick, but volume in terms of the positive volume, it's going down, but so is the negative volume. So let's just see. Guys, I'm really not seeing anything nice here, so I have nothing nice to say about these EMAs. And then, of course, the weekly is just going to be god awful because the daily is god awful. And in fact, if I just turn off my signals here, turn back on our momentum lines, you can see that we actually have the 200 simple moving average that we're now well under. We've rejected off of it, and so that is quite dangerous. We have the 300 simple moving average underneath us, but this is unlikely to provide the support that we want. However, it would be a good target, this 17,750-ish area, if we did get it for a little bounce. We got like a rejection off of the 200. We could get a little bounce off of the 300 over here at I don't know. It's moving up, so maybe 17,800. We can just see, right? So that's a little bit of a difference between price action, but EMAs sometimes work out that way. Guys, let's go ahead and jump over to Ethereum. Pardon me, the Bitcoin CME chart, just to see if we opened up any gaps or anything. And we did not. And we are also below our momentum zones on the CME. So all of this is quite bearish. We are underneath the second boss on the CME chart, the professional exchanges. And so all of this is quite bearish. We are getting a little bit of support off of the macro downtrend on the CME. So that is something that's worth pointing out. It looks like CME is trying to get a little bounce off of this macro downtrend that we've broken out of, even though we're being repressed by the second boss. The first boss is just giving us a little bit of lift here, so we'll see what that turns into. There's a little bit of a difference there on the daily on CME. Now for Ethereum, Ethereum, let's see. Let's go ahead and just take off these EMAs and just go in our order. You can see that for Ethereum, we do have this rising wedge. Let me go to the 4 hour. We do have this rising wedge that has broken down. We've now met the target for that rising wedge breakdown. More or less, we've met the target for it. And so, yes, we could go down a little bit lower to this kind of trend here, maybe 1240-ish. But all in all, I really couldn't just expect more downside, except for the fact that we did lose our momentum zone from yesterday, and we're nowhere near the 2 to 5 day projection where we need to be. I can just delete these momentum zones for Ethereum, and pulling over our new ones, you can see that we're starting the day off by swimming through it, which is how you would like to start your day with a momentum zone. Unlike Bitcoin, which is kind of borderline underneath it, Ethereum is within its current day momentum zone, and that's a good sign. What we'd like to see is it get above that daily momentum zone, and then ideally above this 2 to 5 day projection. But just based upon momentum, because we can see our price structure, we don't really have an interesting kind of structure going on here. Maybe we have a bear flag, right, starting to form, but we just have to wait and see. This rising wedge has just completed its measured move. However, overall, our momentum does look bearish in projection unless we get above 1330. So guys, 1330 is what we need to beat for uber bullishness on Ethereum. We really need to beat above 1300 for Ethereum in order to be bullish. Underneath 1275, I'm going to be 1280. I'm going to be fairly bearish in my bias, and underneath 1260, I'm going to be very bearish on Ethereum. Let's just take a look if there's anything on our volatility. On the 4 hour, we are having a flip to the downside, probably just a contraction. Yeah, just a contraction similar to Bitcoin. On the daily, do we see that same type of volatility buildup and confusion? Da, da, da. Come on, TradingView. Let's go. Okay, yeah, we do see a negative bias on Bitcoin, or pardon me, on Ethereum, and we also see that extreme low. Wow, this is just a massive volatility. Wow, this looks really intense. I haven't really seen this much volatility built up on Ethereum in a long time. So that's quite significant. Um, but it is postured to the downside. That's the problem here, guys. It's postured to the downside. So and the MACD also not looking great. So we're gonna see if this can recover. Definitely, it's waiting for the CPI report. Let's see what happens there. Um, yeah, guys, just a little bit worrisome how much volatility is building up on Ethereum. Okay, let's go ahead and let's see. We did price action, we did momentum, volatility, and of course our good old EMAs. On the daily, it just looks pretty bearish, guys. We're not even above the 4. Let's see the 4 hour. 4 hour might have a little bit of an attempt here. You can see this little bit of a higher low. Just waiting for TradingView. There we go. Yep. On the 4 hour, you do see Ethereum attempting to get up to the 9, but I do see a Alpha 9 knockout coming up, and so this is likely to push it back down, to be honest. But we'll see. Maybe it can try to get above the 9 at 1290. It's just likely to face some resistance, in my opinion, and then maybe try again. Let's see, Ethereum, the professional exchange, looking very similar in terms of its EMAs. Um, for its momentum, you can see that we are below all the critical areas for its momentum, but, and the 2-day Stokes is up here, which is a bit troublesome at 1310. That is troublesome to me. But it is trying to recover at least the daily Stokes, and maybe it could get to the daily MACD. That could have it pop back up. We'll see. This might be just a momentum play, just some type of reversion, but overall, this looks pretty bearish to me, guys. Let's see. I mean, of course, usually I'm calling things in advance, so yes, there could be a reversion, but I'm just saying overall, it looks pretty bearish. Um, Let's go over to stocks, the stock market with the S&P 500 mini futures ES1. And you can see that we failed to capture our momentum zone yesterday. And we definitely failed to capture the momentum zone we needed for uber bullishness for the 2 to 5 day projection. So the stock market just very lackluster. We are holding support on the S&P 500, so that's nice. You can see our EMAs point to the downside though, so not good on EMAs on the 4 hour there. If I do pull over our new momentum zone, you can see we're starting the day. Again, this is good for 24 hours. You can see that we're starting the day inside of the zone, not under the zone, which is a good sign. As long as we can continue to swim in it, and if we could hold above it, that would be positive. And so above 3630 is going to be a key level to watch for bullishness on the S&P 500 mini futures. And then below 3598, I'm going to be bearish. And of course, wow. Okay, so I take that back. To be uber bullish, you have to be above 3645, okay? Wow, I mean, this is just really bad, guys. This looks really bad. I don't even know, man. The 200 weekly EMA is up here at 36.72. I don't know how you get bullish on this, guys. Actually, this looks really bad to me. But let me just to start over, okay? Because I didn't realize it was this bad. The S&P 500, in order to be uber bullish, Jesus, the Stokes is at 37.20. Sorry, this thing is completely just wrecked. Okay, uh, uber bullish above 37.21, bullish over 36.74. Yeah, I mean, I'm already worried. I'm gonna continue to be worried under 36.24, and I mean, I guess our range low is really just some critical level here. 35.70 is just going to be just very, very uh-oh, right? And so, guys, yeah, I couldn't go by the momentum boxes here. See, that's why I'm not like some type of just arbitrary box. I don't make arbitrary boxes. You also have to think about the rest of this stuff. And so those are your key levels for the S&P 500. If we look at the daily, because the 4 hour is so wrecked, I bet the daily just looks god awful. And yeah, I mean, the daily just looks horrific, to be honest. So just tagging the 4 EMA and then potentially we could just continue to the downside. Uh, yeah, just, I mean, we could always have a mean reversion all the way back up into this area, but, and this is a nice little double bottom to do it off of if we can hold that area. It's just, it looks really bad, guys. Let's go to Nasdaq. Nasdaq mini futures here. We can see same thing on the daily, just way under our EMAs. But one thing uh, that we do immediately notice is that our price action is lower. We made a lower low, so this looks even uglier on the Nasdaq. Again, it's a NQ1, the Nasdaq 100 mini futures. And let's go ahead and take a look at the 4 hour just to see if anything interesting is going on Nasdaq. This is an interesting formation. Just waiting for those EMAs to populate. And nope, not even above the 4 on the 4 hour yet. What a disgusting look. It's trying. It's trying. It's just not even there. Let's go ahead and just take a look at those momentum zones. Yeah, totally failed anything, to get anything on the previous day. So just forget about that. Just totally lost it. For the momentum for tomorrow, basically the next 24 hours, we do need to hang on into this pool area. Similar to the S&P 500, we have kind of a complex setup here. The Stoke does look better on the Nasdaq, but this price action is just more wrecked than the S&P 500. So I don't know. Maybe we are going to head down to my target here, right? I had projected a bounce here to here and to here, and I projected that almost a week and a half ago, and boom, guys, like boom, 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 like we're just nailing it. But this does look very ugly. To be bullish, mm, yeah, I mean, to be bullish, I really want to see us above 11,331. Uh, to be really bullish, 11,528. I'm already concerned underneath 11,011. And then I guess just this wick right here, if we take that out, I'm just going to be very concerned, right? Just uh-oh levels is 10,770, right? We don't want to lose that. So there's the key levels for the Nasdaq Guys, this episode has been very long, so I'm just going to just briefly mention that the dollar continues to spike. We did have a little bit of a pullback. It was a bullish pullback. We are continuing to spike up. This is what I was warning you about for the last couple weeks. I was warning you this was most likely going to happen. If we can continue and beat this level of 113.33, then most likely we're continuing on to 114 and perhaps even from there to 118 to 120, which would be very dangerous for markets. VIX is continuing to push up. We are making this kind of formation, which it's not good. Okay, it's not good for trading assets. Guys, I mean, I don't know if you're seeing what I'm seeing, but there is this head and shoulders structure now on the VIX, right? And so um, that's not good, right? That would have a measured move. That would have a measured move up to hell, okay? So if you are looking at the VIX for perhaps some signals, there you go. We could be looking towards hell. Now, this thing has to get rejected fast in order for us to avoid that, okay? So that was your alpha for the day. Stay safe and happy trading.